Okay, hi everyone. This is going to be the second lecture for Chapter 17. Again, we're dealing with accounting for income taxes here. We finished off, we said that there's a multiple step process to calculate this. Specifically, what are we trying to do, right? We're trying to find the provision for income tax expense on our financials. We said we use this thing called the balance sheet approach. And the book defines it as 6 steps. When we do the third video, I'm going to kind of break it down into 3 steps. It's, the third video will probably clarify a lot of the questions with this. But we finished with step 2, so now we're going to look at step 3 where it says calculate your current tax expense. So this is what you're going to currently owe, or it could be your current tax benefit, right? If you were to receive a refund, but normally you owe money, right? And I have here, it's the amount of income taxes paid or payable or refundable for a year as determined by tax law. Most times the current tax expense is a liability from current year operations. However, there are other items that can affect this. So in practice, it's a little bit different than how the book teaches it. CTE is rarely going to be your actual taxes paid on the current year tax return. The reason for this is there's a lot of variables that come into play. We have these like RTP adjustments from prior year, return to provision adjustments, carrybacks, audit adjustment, and then changes in uncertain tax positions. If we look here at 17.5, essentially what's going on here is we start with our PTBI, we do our perms, then our temps, the net amount, that's going to get us to our taxable income, multiply that by 21%, gives us our current tax expense and our income taxes payable. So you'll see a similar process to this in the third lecture. You start with your perms, then your temps, multiply times the tax rate. There you go. And then we'll see how our deferreds just kind of drop out. So the next here, step 4, is once you figure out your current tax expense, then you're going to want to figure out your deferreds. So this is the portion of the income statement provision that reflects the change during the year in a company's DTL or DTA found on the balance sheet. As we've indicated, right, ASC 740 takes a balance sheet approach. And as I have here, the expected future recovery of an asset or future sacrifice of an asset to settle a liability gives rise to a future deferred tax payment. It's recorded in the provision in the year the difference arise, rather than in the year which the future taxes are paid or recovered. So, as I have here, the future tax cost of a taxable temporary difference is a DTL. The company computes the DTL using the enacted tax rate that's expected when the tax liability will be settled. Thus, because the TCJA made corporate tax rate 21%, they had to be cognizant of this. Basically, when they changed it from a progressive tax rate to a flat tax rate, companies had to go in and change their deferreds in light of this. So we can look here at, this is showing some more pronounced examples of it, 17.6 through 17.9, right? So we would have our beginning year, our end of year, our change. So you can follow it here like 1, 2, 3, 4, 5, 6. We ultimately, arise here in our deferred tax expense and the increase in our deferred tax liability. You can see here it's by virtue of the differences between beginning year and year end. Likewise, this one's just saying, hey, if we sold a fixed asset, we had a book basis of a certain amount, we had a different tax basis, right? This in turn could affect our gain, which is going to affect our change in our balance, which will affect our deferreds in our journal entry here. And we can see here, right, the prior tax versus book depreciation. Again, this will make more sense when we look at the third lecture. For the time being, just kind of keep it in your head that you do your perms, your temps, and then the deferreds are going to drop out. So step 5 says, hey, we need to evaluate the need for a valuation allowance. So basically, one of the things here is ASC 740, right, which guides all of this. This basically says you're not allowed to present value any DTA or DTL. It's a future item, but you do not present value it. The reason being is the costs of doing this and the speculation, the mechanics, the calculation are going to be greater than the benefits derived from it. So instead of present valuing, what FASB says is, hey, you need to evaluate each of your DTAs, your deferred tax assets on the balance sheet, and assess the likelihood the expected tax benefit will be realized in the future period in light of your future taxable income, right? Basically, hey, we have this deferred tax asset, a benefit in the future. Are we actually going to be able to use this in the future? We have to assess that amount. And in doing this, if it is more likely than not that some portion or all of the DTA will not be realized in a future period, right? We have this deferred tax asset, but we're not going to have appropriate income to utilize it in the future based off, what we're looking at. We then need to offset the DTA with a valuation allowance. So it's basically like a contra account. In short, right, we look to different factors. We have a DTA. We look and we say, are we actually going to be able to use this? Right? Are we going to have taxable income in light of different things? And if we aren't going to be able to use it in full or part, we have to do an offsetting account, a valuation allowance. Now, things we look at here in the future to determine whether we have and are going to have appropriate income to utilize our deferred tax asset includes things like future reversals of existing taxable temporary differences, taxable income in prior year carrybacks, the expected future taxable income exclusive of reversing temporary differences. So this is one of the bigger ones right here. And then our tax planning strategies. So this is just looking at those items, right? The big one here is, in the future, are we going to have taxable income to use this deferred tax asset? And we're also going to look at our future tax strategies, right? To determine it. So you can look here at 17. If we look, at these are just showing different things they're looking at to determine whether they need a valuation allowance. So basically, hey, they will have enough income to absorb the reversing deferred tax assets. Is there positive and negative evidence that they should evaluate? Right, so here it says, what negative evidence should Elise consider in her evaluation as to whether the company should record a valuation allowance against some or all of the deferred tax assets? So they have carryovers here, and other items more problematic. The net capital loss carryover has a short carryover expiration date. So negative evidence would be kind of things that would say we're not going to be able to use the DTA. On the other hand, when we look at positive evidence, whether we should have the DTA, it says here, so 2 additional sources of positive evidence are projections of future taxable income from sources other than the reversing temporary difference and future income from tax planning strategies. So you kind of have to look at both the good and the bad when you're determining whether you need a valuation allowance. This right here is just showing you, it says assume a company had pre-tax book income, a loss of $5 million and $2.5 million in 2019 and 2020 respectively. How might this additional fact influence the assessment about the need for a valuation allowance? So basically here, hey, the company would have loss over the last 36 months. And ASC 740 indicates that a cumulative loss in recent years is considered objective negative evidence that may be hard to overcome, right? So the individual here, they'd have to consider other sources of positive evidence that will outweigh the significant negative evidence. So we have way more negative evidence. We're not going to have enough taxable income in the future to use this. We've been at a loss for the last 3 years. You're going to need to bring a lot of positive evidence to the table to kind of counteract that. So 1710, 1711, let's look here at 1712. This right here just says, hey, we just lost a big account to a competitor, but the company reported net income in the current and prior 2 years. How might this additional fact influence the assessment about the need for a valuation allowance? Well, as it has here, right, expectations of future events can outweigh historic results. In this case, the individual would have to seriously consider whether a valuation allowance would be required to the extent the reversing taxable temporary difference would not absorb expected future losses. So you just have to, again, be aware of this, even though we've been in a positive net income position over the last 2 years, we did just lose a big client here. So the final step here is the deferred tax expense. This is going to just drop out. We'll look at this. Like I said, I prefer teaching it in lecture 3. This is more giving you the book way of it. So kind of moving on here, after we get through the provision, right? We talked about what is the provision. We said there's 6 steps to calculate it. In the next lecture, we're going to kind of whittle that down to 3 steps using some different examples. But the next area that we're going into are uncertain tax positions. So as I have here, taxpayers in the IRS can disagree over positions taken on a tax return. These are going to be called uncertain tax positions. We need to consider this when we're calculating our provision, right? And basically, we have a standard here for GAAP that tells us how we should deal with uncertain tax positions. And really, it's this FIN 48, right? It gives you a 2-step process: recognition and measurement. Basically, the company here is they're going to have 2 steps. Should they recognize it? How should they measure it? And they're going to record the largest tax benefit that has the greater than 50% cumulative chance to be realized on the outcome of the tax position. So the overall idea here with this is, right, sometimes when you're doing a tax return, the law or the position you're taking can be uncertain, right? Maybe you're reading into it too much, you're taking an aggressive position. These are things that are sufficiently common because the law can't cover every single situation, right? They can just give kind of general rules and laws. So there, a lot of times there's gray areas in there. When you're taking a position that is in one of these gray areas, it could affect your tax return provision, right? If you get audited on this and you're not allowed to take it, then that would affect your income, which would affect how much taxes you pay. So we have here this FIN 48, right? And we also have ASC 740 that comes into play, right? So ASC 740 applies to all income tax positions, including those taken on prior, current, or projected future year returns. It considers perms and temps, as well as the decision whether to file a tax return. So a tax position is just like any position you take on a tax return, right? Like, I'm going to take this deduction. I'm going to report this income. I'm going to take this credit, right? It's just a position that you're taking on the tax return. It's like a declaration almost. So as I have here, so suppose a company takes a tax position that it should take a certain deduction. This deduction causes an NOL. ASC 740, right, this is going to determine whether the company can recognize the deferred tax asset from the NOL on the balance sheet. Thereafter, the company has to determine if it's more likely than not the DTA will be realized for purposes if a valuation allowance is required. Okay? Then we have this overarching FIN 48, right? And the idea with it is it's a two-step process. Companies must first determine whether it's more likely than not, that is to say it's a greater than 50% chance, that the tax position will be sustained on audit. If this is met, the company is allowed to recognize the tax benefit on the financial statements. Basically, you can reduce your current tax expense. If it's not met, you got to stop here. So first thing is this tax position more likely than not going to be sustained on audit? If it is, right, it has a greater than 50% chance, how much, or, can we take the position for? How big of a deduction can we take? So basically what happens here is the company has to determine the amount to recognize on the financial statements, and they do this with a probability analysis. The amount they do recognize, the answer to like how much, right? The first question is, are you allowed to take this deduction or this position? The second question being, for how much are you allowed to take? The amount you recognize is the largest amount of the tax benefit that is greater than a 50% chance of being realized upon settlement with the tax authority. The amount not recognized, namely the unrecognized tax benefit, is recorded as a liability on the balance sheet. For this amount, we're going to debit our current tax expense, credit our taxes payable. So I'm going to have a PwC video in there that goes over this FIN 48. But we have an example here, right? Let's imagine that we have $1 million pre-tax book income. This includes a $200,000 tax deduction. After conducting a probability analysis, right? You're not going to be asked to conduct a probability analysis. This is just something that, the actuaries would do. We realize that this deduction has a 75% chance of being sustained, right? And there's a 40% tax return, meaning at max, right, at the end of the rainbow, if this was perfect, we would have an $80,000 tax benefit, or a reduction in our tax liability, right? The $200K deduction times 40% would give us $80K in taxes that we save. So here's the idea with it, right? The tax attorney or the actuaries, they would give you all of the possible outcomes from this position. And they would show you both the individual probability and the cumulative probability. So basically what they would say is they would give you something like this, right? Here are the different outcomes we see from this. We see you could get 80K, you could get 70K, or you could get 65K. For each of them respectively, right, you have a individual probability of the outcome. So, 80%, there's a 15% individual probability, 70K, there's a 30% individual probability. And then they're also going to give you a cumulative probability here. So 80K is 15%, 70K is 45%, 65K is 55%. So basically what they're telling us here is the amount we are supposed to recognize, what we actually take as the deduction, is the largest amount of the tax benefit that has a greater than 50% cumulative chance of being recognized. So in this case, right, only one of them has greater than a 50% chance cumulative benefit. So that's the one we're going to pick, the 65K. So in this case, right, we've identified the largest cumulative benefit that has a greater than 50% chance. There's really only one of them here. Thus, the amount of tax benefit we're allowed to take on the financial statements is $65,000, right? The difference between the full benefit at the end of the rainbow, right, the 80K, and the amount on the financial statements, the $65K, is going to be the unrealized tax benefit, right? That's going to the unrecognized tax benefit, which is going to be right here. So you can kind of see the math with it, right? We have 1,000 PTBI times the 40% tax return, which is the full benefit. Plus we have to add to that the unrecognized benefit, which is going to be the $15,000, the difference between the 80 and the 65. There you're going to have your 415 from that. Other considerations here, right? So when you're looking at uncertain tax positions, you have to, be aware of all of the facts and circumstances. So ASC 740 requires a company to monitor subsequent events, right? Are there going to be new laws or regulations that could affect, the probability analysis here, right? If we know the tax reform is coming or that they're changing the law directly on this deduction, we'd have to be, aware and cognizant of that. Likewise, we have to accrue interest and penalties on liabilities established for potential future tax obligations. So these can be on our uncertain tax positions or taken separately. We have to be, aware of our unrealized tax benefits. And then the other thing here is corporations with assets of 10 million or more are required to file a Schedule UTP uncertain tax position with their Form 1120. This discloses the nature and amount of the UTPs. So this right here is just showing us the unrecognized tax benefits from 2018 to 2019 to 2020. In the next idea here, it says, with regard to financial statement disclosure and effective tax rate, we're going to look at the effective tax rate and the statutory rate. Basically, ASC 740 requires corporations to classify deferred tax assets and liabilities as non-current on the balance sheet. And then you have to obviously disclose the components of the net DTA, the DTL, and the valuation allowance. You can do this in a footnote. So this right here is just showing a breakout of it. And then we'll see, right, we have to do kind of a recon here that we'll see in Lecture 3. It says ASC 740, this is going to require corporations to reconcile their reported income tax provision with the amount of income tax expense that would result from applying the statutory rate to its PTBI. So we'll see exactly how we do this, right? How we go from kind of the statutory rate, what our hypothetical provision would be, versus what our effective tax rate is, how we got there. And basically we have to reconcile to do that. And then the last slide here, this talks about financial statement disclosure and the effective tax rate. There's basically a bunch of different tax rates here we have to be aware of. So the effective tax rate, this is going to be a major benchmark for corporations in the same industry, right? You're going to use this to compare corporations when you're looking to invest. This is also known as the structural tax rate, and it's a better representation of the corporation than how you would normally see it, right? Or maybe a nominal. Basically, when you look at the structural, the cash tax rate, and other items, they're giving you a way to compare the business here. So there's also our cash tax rate. So this is going to be our cash taxes divided by our PTBI. And as I have here, in addition to the Form 10K, corporations have to file a 10Q. So we have our annual and then our quarterly. The corporation has to calculate at the end of each quarter its best estimate of the effective tax rate expected for the fiscal year end, and thereafter apply this rate of income reported in the quarter. We have to and then reconsider the estimate of the annual rate at the end of each quarter. So with all of this, right, we will look at the third lecture. When we do the problems in there, it actually will better explain all of this. Like we'll have step 1, step 2, step 3. We will see how these words and phrases really give rise to different contexts and settings and how we can apply them. So with that, we'll stop here.